Hi, this is Michael King, and welcome back for Capital Structure Part 2. We're going to talk about two theories that explain the choice of capital structure, one called the static trade-off theory, which relies on the benefits of tax shields versus the cost of financial distress. The second, called the pecking order theory. We'll also briefly touch on a third theory, the agency theory of capital structure, before looking at capital structure in practice. I'm going to conclude by giving you an acronym, FRICTO, that will allow you to think about the different dimensions of capital structure. The two main theories of capital structure are the static trade-off theory and the pecking order theory. The static trade-off says there is a trade-off between the benefits of the tax deductibility of interest on debt and the cost of financial distress as a firm takes on more leverage and has a risk of going bankrupt. The pecking order theory says that firms have a specific order in which they want to raise money. They will rely on internal funds first, generated from cash from operations, which are cheapest. They'll issue debt second, and equity last when raising capital. The static trade-off theory has been useful in explaining differences across many industries. We see some industries where debt levels are high and others where debt levels are low, and it seems to be related to the stage of maturity of the industry as well as the degree of fixed assets. However, this theory cannot explain why some profitable companies have little or no debt, such as high-tech firms or pharmaceutical companies. These studies also find no link between the benefits of tax shield and firm value, and they show that debt ratios have been high over time despite marginal tax rates changing, which is inconsistent with the static trade-off theory. Given that the WACC falls as leverage increases, why should a firm not issue as much debt as possible, as we saw in the diagram earlier? Well, the answer is that diagram does not include the risks of bankruptcy and the cost of financial distress. You may recall that Modigliani and Miller said that there was no cost of financial distress in their model. Researchers find that the direct and indirect costs are as high as 25% of the value of a firm, where the direct costs are legal and administrative costs, and the indirect come from a variety of costs, such as management time, dealing with bankruptcy, unwillingness to invest in profitable projects, and potential gambling on other projects that may be negative NPV, customers or suppliers that no longer want to deal with the company, and the loss of potentially the best employees. The value of the firm will decrease as a function of both the costs of financial distress and the probability. If the costs of financial distress are 100 million and the probability is 25%, the cost times the probability suggests that the value of the firm will decrease by 25 million. Studies do find that the costs of financial distress vary across firms. They tend to be lower for firms with more fixed assets because these can be claimed by creditors in the event of default. Firms with stable cash flows and fewer long-term commitments to customers have lower costs of financial distress. The costs are higher, however, for firms with intangible assets, such as technology firms or pharmaceutical companies, where patents in human capital tend to be very large. They also are high firms with growth opportunities, because if these firms go bankrupt, they won't be able to exploit all that future profitability. And finally, the costs are high when firms have tax loss carryforwards, because going bankrupt makes those tax loss carryforwards worthless. So here's the revised chart showing the market value of the firm when adding debt. Notice that the value of the unlevered firm is a dotted horizontal line. The value of the firm based on simply the present value of tax shields is the green line and increases as debt is increased. The value of the firm taking into account both tax shields and the value of financial distress is the blue line. As you can see, the green line would suggest that the value of the firm is always increasing as the WACC is decreasing. However, the blue line shows that as you increase debt, there are benefits initially from tax shields, but there are increasing costs of financial distress, which is the gap or space between the green line and the blue line. As a result, we get this convex shape or reverse U, where we see that there is a point where value is maximized before declining. This level is where companies will find the optimal ratio of debt to equity. In practice, it is hard to find this optimal, but firms will usually have an idea or a range where they believe the optimal capital structure lies. Looking at the book by Booth, Cleary, and Rikita, we see the diagram of the WACC on the top, plus its components, the cost of equity and cost of debt, and the value of the firm in the bottom, the green line. As you can see, the cost of debt is lower than the cost of equity. The cost of debt increases slowly, but then increases more rapidly as the amount of leverage increases. The cost of equity is increasing as debt is added, but it accelerates when the cost of debt accelerates. The combination of debt and equity leads to a declining WACC initially, but then a rising WACC. The bottom figure shows that the value of the firm is maximized where the WACC is minimized. This is the main takeaway from the static trade-off theory. The pecking order theory says that firms will rely on internal funds generated from operations first because that is the least costly. When a firm does need to raise external capital, it will always go with debt, which is cheaper, followed by equity, which is more expensive. The reason that firms will not issue equity is because they know about the attractive growth opportunities that are available to the firm. We say that the managers and owners or insiders have asymmetric information over outside capital providers. For this reason, when they do choose to sell equity, there is potentially a negative signal. It could signal that equity is overvalued, which is why managers and owners are selling equity, or that the firm is doing badly. Otherwise, they would be issuing debt rather than equity. The only time when this signal is not negative is when it is clear that the firm already has too much debt, in which case they have no other options, or when the business is so risky and uncertain that borrowers will clearly not lend. In summary, both the trade-off theory and the pecking order theory provide insights which work for some firms. The trade-off theory works for large companies that have more leverage, firms with more fixed or tangible assets, and companies that are growing and borrow less. The pecking order theory shows that more profitable firms borrow less because they can avoid debt and use internal cash flow. Growth companies also borrow less. When companies issue equity, the announcement causes the share price to fall because of the negative signal. Another view of capital structure is that large companies suffer from what is called a principal agent problem. They're run by employees who do not own the firm. The firm is owned by its creditors and shareholders. These managers, or agents, look for ways to extract rents, such as through high salaries or by consuming perks, rather than maximizing a return or minimizing risk. These managers have access to information that is not available to anyone who's not involved in the day-to-day running of the firm. As a result, shareholders will have to pay a cost in order to hire a board of directors, or they will have to negotiate covenants if they're bondholders to restrict the room to maneuver for the managers. Michael Jensen came up with a theory called the free cash flow hypothesis, which argues that by taking on leverage, managers are disciplined and are forced to reduce cost. If they don't, they will lose their jobs when the firm goes bankrupt. And this high debt, high leverage aligns the interests of the insiders with their shareholders. In practice, there are a number of factors that affect the willingness and ability of a company to issue debt. It depends on their profitability, the amount and size of tangible assets that can be used to secure the debt, how much cash is available from the business, the company's market share, their size, their future growth rate, and the ability to issue debt or equity in favorable capital markets. Let's take a look at surveys that were done in Canada of how companies choose their capital structure. We see that companies do tend to focus on their credit rating, which is implicitly a measure of their debt to equity. They want to continue to make investments. They want to take the benefit of the tax shields by having debt, but they also want to avoid cutting their dividends and be able to maintain a stable dividend. When thinking about capital structure, think of the acronym FRICTO. FRICTO stands for flexibility, risk, income, control, timing, and other. Each one of these will lead you to ask a question that is relevant to capital structure. Flexibility means keeping your options open, such as not borrowing today so that you can borrow in the future, keeping lots of cash on hand, and only borrowing and taking on leverage when you need to. Risk is about the ability to make fixed payments. Taking on debt increases interest expense, which could lead to bankruptcy. Income has to do with net income, particularly earnings per share and ROE. We see that taking on debt reduces net income, although it does bring benefits in the form of tax shields. The ultimate impact on return on equity depends on how the money is spent. Control refers to ownership. Owners do not want to give up control by selling equity, which is why they prefer debt. However, issuing debt does have some implications for control when the bonds are combined with covenants that limit the ability to manage or sell assets. Timing has to do with the current market environment and whether it is favorable or not. When interest rates are low, it's a good time to issue debt. When stock markets are hot, it may be a good time to issue overvalued equity. And there will always be other issues that are relevant or specific to a particular firm. Let's look at an example with Apple and the decision to issue debt and increase its leverage. Well, issuing debt would not be an issue in terms of flexibility because Apple has lots of cash and a low level of debt. So taking on a modest amount of debt would not reduce its flexibility. Raising debt would increase the credit risk or the risk of default for Apple, but debt is low for Apple and it has strong EBIT, so interest coverage and the ability to pay debt is very high. So risk is not a concern initially. Likewise, interest expense could be used to generate tax shields, but it will reduce income, lowering earnings per share. However, if the money is reinvested at a high rate of return, it can increase return on equity over time. Control, issuing debt does not reduce ownership by insiders or by existing shareholders, which is favorable, although it may introduce some covenants. The timing for issuing debt is very good, particularly in the recent years when interest rates have been extraordinarily low. Another consideration for Apple is that it does hold a lot of cash, but it's all held offshore and would be subject to taxes if it were to be repatriated. So we see that Apple actually started issuing debt in order to avoid paying these taxes because shareholders were demanding that the money be used to pay out dividends and to buy back shares. Whenever looking at capital structure, remember FRICTO and go through each of those categories.